Welcome to Module 4. Believe it or not, I'm coming to you from New Orleans, Louisiana. But the show must go on no matter where I am. So we're going to cover a large element of entity and jurisdiction planning variables in this module. So it's going to be a little different than our last modules. We're going to start with the learning objectives and then go deeper into entities, starting with the sole proprietor. All right, I'm recording using my headset, so if I sound a little bit different, sometimes I sound like I'm in an echo chamber when I use this. But as you know, I'm at a hotel in New Orleans, and I don't want to be too weird about the neighbors in the next room over. So here's our Module 4 learning objectives. We're going to examine the different types, the different typical entities, and see how they might compute taxable income differently. And if you remember Jim and Pam from Module 1, we're going to show more examples of how entity choice makes a difference. Then we're going to turn our attention to jurisdictional issues. And we'll start with U.S. states and how they decide and who they're going to tax using something called nexus. And then we'll examine a common model of dividing income between the states. And then lastly, we'll take a brief overview of international tax issues from a U.S. perspective. And of course, the tax law changed this dramatically, so it's going to deviate pretty heavily from the book on that last one. But we're going to start with sole proprietors. Sole proprietor is an unincorporated business owned by one individual. There's generally no separate legal entity, and this remains the most popular form of doing business in the U.S., at least from a count perspective, not necessarily from a size perspective. So as we learned in an earlier module, sole proprietors report their income on Schedule C, that's part of their Form 1040, and thus they are flow-through or pass-through entities. Since we've already covered the calculation of business income, let's look at one of the unique deductions that's often used by a sole proprietor, and that's the home office deduction. So the tax law on this is clear. Generally, no deduction is permitted for the cost of the taxpayer's dwelling. However, in limited circumstances, a home office deduction is permitted. The requirements include that the home office must be used exclusively and regularly as the principal place of business, or that the home office is used as a place to meet customers in the normal course of business. So the exclusive rule is taken quite seriously. For example, taxpayers had the exclusive rule overturned because a guest bed was located in the home office, or the only television in the home was the home office. So unless you are prepared to justify that no one in your house watches TV, better not put your only screen in your home office. So here's a handy flow chart provided by the IRS to help with the home office deduction requirements, and you may want to use it to answer the next few questions. So let's read about Joe and determine if he can take a home office deduction. So Joe's office is used exclusively. He has no other fixed location, and just having a few administrative duties done elsewhere doesn't preclude the home office deduction. So as a result, Joe is eligible. All right, let's read about Al. So Al's office is also used exclusively. He has another fixed location, and using his home as an office is not for the convenience of his employer. So as a result, poor Al cannot take the home office deduction. All right, our last one is about Anne. So Anne's office is used exclusively. She meets with clients there regularly, and that use is substantial to her business. So as a result, Anne gets the home office deduction. Once a taxpayer is eligible for the home office deduction, now they're going to have to determine the amount of the deduction. So direct expenses are charged 100% to the home office deduction. So for example, if repairs are required to the space that's used only as a home office, those repairs are a direct cost of that office. Contrast direct costs with indirect costs, which must be allocated. For example, the home typically has only one electric bill, and the cost of electricity, therefore, is both a personal and business expense. So most often, indirect costs such as utilities, cleaning, depreciation, they're going to be allocated between personal and business use based on the proportion of home office square footage to square footage in the total home. Home office expenses are limited to the income of the business before the home office deduction. Like Code Section 179, the home office deduction cannot cause a tax loss for the business. Note that in the case of an employee claiming a home office deduction, since miscellaneous itemized deductions have been repealed, no such deduction is permitted any longer. Let's do an example together. To allocate Haywood's expenses, we need to determine the proportion of square footage used by the home office. That's 200 divided by 2,000, or 10%. We can now compute the business portion as 10% of each indirect cost. The total deductible expenses are limited to the income of the business before any deduction. That's $1,500. And now is when things get complicated. We need to categorize the expenses as either Tier 1, Tier 2, or Tier 3. Tier 1 is interest and taxes. Tier 3 is depreciation. Tier 2 is everything else. This matters because Tier 1 expenses can be deducted even if a loss is created. If after deducting Tier 1 there is still any business income left, then Tier 2 can be deducted, and then if there's any income left, Tier 3 can be deducted, but never more than the income. In the case of Haywood, all of Tier 1 can be deducted, leaving $350 of income. Since Tier 2 is only $200, all of Tier 2 can also be deducted, leaving income of $150. However, only $150 of the Tier 3 depreciation is deductible. The remaining $100 of depreciation will be carried forward indefinitely. To make life simple for taxpayers, an alternative method is available under IRS guidance. Take the square footage of the home office and multiply by the eligible rate, which is $5 for both 2017 and 2018. For Haywood, that's a simple $5 times 200, or $1,000. Shifting gears a bit, recall that we covered employment taxes back in Module 5. For those that forgot, employment taxes are paid 1/2 by the employee and 1/2 by the employer at rates of 6.2% each for Social Security and 1.45% each for Medicare. That's 7.65% for each, or a total of 15.3%. Recall also that Social Security tax applies only up to the FICA cap, which was $128,400 in 2018. Note also that the employer takes a deduction for their share of the employment taxes, like any other ordinary and necessary business deduction. So if Tanya, an employee, generates wages of $40,000 in 2018, what are her and her employer's employment taxes? Let's start with her share. 6.2% of $40,000 and 1.45% of $40,000 is taxes of $2,480 and $580 respectively. Her employer pays the exact same amounts. Nancy is doing a little better, and she earns wages of $140,000. Her Social Security tax is only up to the FICA cap of $128,400, or $7,960.80, whereas Medicare has no such cap, and the full $140,000 is multiplied by 1.45%. Now, the employer's share would be exactly the same. Okay, so now why did we revisit employment taxes in the middle of our sole proprietor video? Because being self-employed does not eliminate the requirement to pay employment taxes. It's just now it's called self-employment tax. Self-employment taxes are based on the business income, and because there is no employer,
self-employment income is subject to both halves of the tax. Thus, Social Security is 6.2% times 2, or 12.4%. And likewise, Medicare is 2.9%. The FICA cap also applies to self-employment income. So even though the self-employed pay both halves of employment taxes, the self-employed are entitled to a deduction. Rather than have that amount reported on Schedule C, this is reported as a 4 AGI deduction on what is now Schedule 1. By segregating the deduction of 1/2 of employment taxes from Schedule C, the deduction that the employer gets is not going to be accounted for by the self-employed. But there's a reason for that. If the amount of income that is subject to self-employment tax includes a deduction for self-employment tax, then the calculation becomes circular because they become interdependent on one another. As a result, a simplified method is used. When determining how much income is subject to self-employment tax, the taxpayer is entitled to a 7.65% haircut. Or in other words, take the Schedule C profits and multiply it by 92.35%. This is equitable to the 1/2 deduction for taxpayers with income up to the FICA cap, and actually is a larger deduction for those with income above the FICA cap. Self-employment taxes are reported on Schedule SE, which has both a long version and a short version. The long version is for a taxpayer with both wages and self-employment income that exceeds the FICA cap, so that more than the maximum amount of Social Security tax would not be charged. You can follow the calculation of self-employment taxes on Schedule SE starting with line 2, where the amount from Schedule C is brought over, and then totaled on line 3 with the 7.65% haircut applied on line 4. Line 5 computes the tax and deals with the FICA cap, and then line 6 provides the 1/2 of the tax to be deducted on Schedule 1, like presented earlier. Let's prepare Tanya again, except this time as self-employed. Because this is self-employment income, she gets to take a 7.65% haircut. Because the income amount is less than the FICA cap, it's all taxed at 15.3%, and she can take 1/2 as a 4 AGI deduction. Nancy, with the higher income, is also eligible for the 7.65% haircut, but her business income exceeds the FICA cap, and so her Social Security tax is only up to the 128.4. Her Medicare tax is on the full amount, and of course, she is also eligible for the 1/2 of self-employment tax deduction. Although almost repealed, the so-called Obamacare, or Affordable Care Act, 0.9% Medicare taxes on wages above $250,000 if married filing jointly, or $200,000 if single and head of household, this tax still applies. The additional tax applies only to the employee and not the employer. If Ivy and Andy file jointly, and Ivy's wages are $260,000, then Ivy's employer is going to withhold on wages in excess of $200,000, even though the limit is $250,000 for married filing jointly. Withholding starts for all taxpayers at $200,000. Andy's additional $30,000 in wages creates total combined wages of $290,000, which is $40,000 higher than the married filing joint threshold of $250,000. Thus, Ivy and Andy will owe 0.9% tax on the $40,000 of excess. But because Ivy's employer withheld on $60,000 of Ivy's wages, they'll actually be entitled to a refund when they file their income taxes.
All right, we made it through our first Module 4 video unscathed. Video T10B is on partnerships and LLCs is next. Thanks for watching.